Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show. Welcome back, everyone, to the DIY Wealth Canada podcast. I'm Nelson, and I'm here with Bob. Today, we are going to talk about REITs, an all REIT edition of the podcast. I'm excited because I'm a bit of a REIT nerd. I have a soft spot for REITs. I've always had a soft spot for real estate, and rather than owning physical real estate like I used to, I own REITs now. So I'm excited about today's show, and I'm excited to talk to it with Bob. So Bob, how's it going? And are you excited to talk about REITs today?
Yeah, doing well. Yeah, REITs are quite an exciting topic, actually. We certainly own quite a few of those. And I think they're great investment to own rather than physical real estate.
I agree wholeheartedly. We'll really get into that part in sort of the middle of the podcast because I think it's a huge advantage for the people listening. But first, Bob, what exactly is a REIT and how exactly does that differ from physically owning a house? How is it a different investment process than sort of doing it physically, like a lot of real estate investors do?
Yeah, so a REIT stands for Real Estate Investment Trust, right? So essentially it's a company that owns, operates, or finances income-producing real estate, right? So you can imagine a company may own or operates, shopping malls or offices or apartment buildings, or a mix of all those, right? And they're also like warehouse and things like that. And typically, a REIT, they typically have, they pass down anywhere from 70 to 90% of the income directly to the investors, right? And so unlike your, TD or Enbridge, where the income of these companies is taxed first before they get passed down to the shareholders as form of dividends. For REITs, they just get income, they take 10%, and then they pass 90% directly to investors. So that's why typically REITs have a little bit higher yield compared to some of these dividend stocks that you're aware, and REITs, they also don't get the eligible dividends treatment, right? So they're, in terms of tax consequences, they're a little bit more complicated. And that's why REITs are good to hold in either TFSA or RSP, or if you're not from Canada, tax advantage accounts.
Yeah, perfect. I think that's the really important differentiator there that you mentioned, is that they have different rules than a normal income producing investment. The income is generally not taxed on a corporate level. Or a big chunk of the income is passed on to individual investors where it is taxed there. Now, a REIT can do all sorts of sort of fancy accounting things to minimize tax owing. We won't get into that because this isn't an accounting podcast, but people should know that REITs can do that to sort of impact or massage the amount of taxes that their unit holders might owe. But for the most part, it is a different structure that isn't quite the same as a normal dividend stock and will be taxed sort of accordingly. Bob, can you talk a little bit more about sort of the kind of maybe the categories of REITs? You mentioned a few of them where it's like, we have residential, there's office. Maybe kind of just tick down some of those and sort of maybe talk a little bit about each kind of REIT there.
Yeah, so there's wide scope with different REITs, right? So the more traditional ones are offices or residential, as Nelson mentioned. It could also be retail, right? So it could be, shopping malls or business rentals, right? It could also be logistical centers or warehouses. And even nowadays, with the prominent of data centers. Not there are data center REITs or even REITs that own cell towers, right? And then there's also REITs that focus on mortgages and mortgage securities that are tied to certain types of properties. So you could get really into different types of REITs, but generally speaking, the REITs that you see available on the market are traditionally, I would say, offices, residential, retail, and logistical, right? So kind of these are the four main ones. And then some REITs may only focus on one of them, but some REITs are kind of a mix of two or three or even everything. So you need to do a bit of research what kind of properties these REITs own before you really figure out where to invest.
Yeah, I think that there used to be a call for this more diversified REIT. It was sort of this kind of one-stop shop kind of thing where you could get access to multiple different asset types. And I'm thinking of way back, say 20 years ago, and when REITs really first debuted in Canada, you had RioCan, which I believe is the oldest REIT in Canada. And you also had H&R REIT, which back then was a little bit of retail, a little bit of office, a little bit of industrial. They mixed in some residential starting about 10 years ago. They started expanding into the US residential market. And that was really the common way to buy a REIT back then, was it was just everything under one roof, and people enjoyed that. And now, as things have changed, they become much, much more specialized, where not only do you have, say a retail REIT, but you might have something like Automotive Properties REIT, which owns just auto dealership real estate, or Primaris REIT in Canada, which owns Canadian shopping mall space, enclosed shopping mall space. So they become much more specialized over time as investors have sort of asked for that, I think.
Yeah, and then there's also like healthcare REITs, right, where you could have like Chartwell retirement residences. It's only like healthcare, like retirement homes and things like that. Even in the States, there's Omega Healthcare, which is a REIT that invests in healthcare. Like could be like retirement homes or even offices that are healthcare related, right? So it's interesting that the REITs are quite specialized nowadays.
Yeah, that's it. Not only are you completely right about that there are healthcare REITs, but in terms of seniors living, I know that Chartwell, they view it as there's sort of three levels of care. And it's kind of like level one, which is we help you a little bit. Level two is we help you some. And then there's level three, which is long-term care, which is extremely regulated by the government. And so Chartwell has said, we don't even want to be in long-term care anymore. We just want those top two levels because of that. So that's how specialized that REITs have gotten, is that a company like Chartwell has said, okay, we only want one specific kind of retirement REIT rather than kind of having them all under one roof. So that's the direction the market has gone. And I believe the market will continue to go, because you look at a management team, and what are the odds that a management team has the capabilities of picking very good residential, retail, office, and industrial REITs scattered all across North America? I would say that that's probably pretty small. It's just too big of a market for them to keep an eye on, versus if you specialize, that market, then that's obviously a lot easier to kind of keep your eye on. Bob, let me ask you about what's an advantage? What are some of the advantages to REITs versus physical properties? Like, why would you go about, if you want real estate exposure, why would you do it via a REIT versus building your own personal property portfolio?
Yeah, I think there are a few key advantages, right? So one is REITs are trading in the market, so it's easy to liquidate, right? So unlike physical real estate, where if you're buying a house or a rental property, it's sometimes hard to purchase and exit, there's transaction fees quite significantly compared to your trading commission, right? And even nowadays, a lot of these online brokers don't have trading commissions anymore. So it's easier to liquidate. And then two, I mean, the biggest draw for REITs is it's again trades like regular stocks, or you just don't have to worry about these like what you're actually owning in terms of properties, right? So imagine you're a landlord renting out your apartment to tenants, and things break down, right? And you have to go fix that or hire somebody to repair, which could take a lot of time. Whereas REITs, you have the management company deal with all that kind of stuff. So you're really just there to invest your money and collect the distribution, and also seeing the share price appreciate over time, right? So from that point of view, it's quite attractive because you're no longer you don't need to be involved in the management of the properties.
Yeah, I think that's a fantastic point that you had there, where you don't have to go and fix any toilets. And I owned physical property for a long time, and I was fortunate that I had a wonderful property manager. Shout out to my dad, who managed those for me for free for a long time. I appreciate that, because they say it's passive income. It's not really passive income. There is a certain amount of work that needs to be done. And if you want to go down that rabbit hole, you can say there's a certain amount of work that needs to be done for everything. Like a dividend stock, you have to keep an eye on it and so on. But there is a certain amount of active management in real estate, or else you hire out that active management, usually at a pretty high cost for the individual landlord. I'll also mention that REITs let you get exposure to sectors that you wouldn't normally buy, and that a regular investor would have no way to buy. One example is like industrial real estate. A warehouse, a 100,000 square foot warehouse. I don't even know how much that would cost, but for the average person, it's just you just can't do it. And even if you could, you don't have the expertise to be able to go into a transaction and be able to kind of get the best of a seller. You're just in such a bad spot there. So REITs give you that ability to sort of buy that asset that you wouldn't normally have access to. And one more thing I'll mention is that there are periodic deals on the public market that are a lot easier for an investor to seize versus buying real estate themselves. Real estate is such a insider driven business that if there's a warehouse that comes on sale, Bob, there's no chance that they're calling you or they're calling me. But if there's a warehouse REIT that goes on sale, I know that just as much as everyone else knows that. Do you factor that in when you buy, when you're looking at a REIT? Do you look at sort of what's on sale and try to find those from a value perspective? Or are you more of a quality focused guy?
A bit of both, right? I'm probably more of a quality focused guy, but yeah, you're absolutely right. Like a lot of these deals, like physical real estate, it would be very, very hard to find them, especially in these specialized sectors, right? Like residential, I think most people there's some level of understanding, right? But especially when you get into like industrial, like it's so hard to get into that space without being like a complete expert, right? Where you need to have a lot of assets in order to tap into that market. So that's where REITs are quite good, because that allows you to, buy as low as fractional shares, or as many as 100,000 shares, whatever amount of money you have, right? So I think investing in REITs is pretty good, and it also allows you to diversify your portfolio in different asset classes, right?
Yeah, I'll tell a story about, talking about how it's really hard for people to get into the real estate market. Like I said, I owned physical property, and I owned physical property in a small town, which was a fantastic place to do it because you have way less competition there. And it was also 20 years ago when I was buying these properties, which was back when Canadians weren't so in love with real estate. And even back then, residential properties in this small town, they were gobbled up. The good ones were gobbled up by real estate agents very quickly. Real estate agent would see that something was listed, or it wouldn't even make the MLS. It would get listed, and then real estate investors or the realtors or the investors that they had in their pocket would just snatch up the best deals immediately. And how do you compete against that if you're a nothing buyer? You're just some guy who decides he wants to put 10% of his portfolio in residential real estate. Very, very hard, which is why I love REITs so much. REITs, they even the playing field. Anyone can look at a REIT balance sheet. They can look at the properties, they can do their research, and they can say, hey, this is undervalued or this is not undervalued. That's what I really love about REITs is that democratic kind of view on things. Bob, what would you say is your favorite REIT sector in terms of, there's just something about it that you really like that sector, and it's something that you can envision owning for a long time. Do you have a favorite, or do you like having a little bit of each like I do?
Yeah, I think we used to own many different types of REITs, and over time we have reduced the number of holdings that we have. Like right now, we only have 3 in our portfolio. But generally speaking, I like retail because it's easy to see, right? So you could drive by a shopping mall, you're like, oh, this is owned by RioCan or Smart Centers, and you could see how the shopping malls are doing, right? And then you typically they have like anchor tenants, so you kind of tell whether the REIT is doing well or not. Now, I also like industrial because, like Nelson, you were saying, like these warehouses, it's very difficult to tap into as an individual investor when it comes to real estate. And with the boom of internet companies like Amazon in particularly, there needs to be a place or places to hold their inventory, right? So that's where these industrial REITs are quite neat, because can you imagine Amazon having to ship their inventory over the country, right? Typically what happens is Amazon would have warehouses within major cities like Vancouver, Edmonton, Calgary, Toronto, right, which allows them to quickly ship out these things that you purchased, right? It doesn't make sense to have all their inventory sitting in Toronto and then having to ship them from Toronto all the way to the West Coast, for example, right? So that's where the industrial REITs are quite interesting for me, because I think that's a booming segment. How about you, Nelson?
It sounds like you're taking more of a sort of a top-down approach where you're looking at it and you're saying, okay, I like the industrial sector, I like the real estate sector, and then you kind of work down from there. For me, what I used to do is I was laser focused on trying to find the cheapest assets I could. And I would measure it in one of 2 ways. I would either look at the cap rate, which for the people who aren't familiar with real estate, that's essentially a measure of your rate of return. So if a portfolio is an 8% cap rate, then you're getting an 8% return. I would focus on the highest cap rate I could find, or the kind of biggest discount to replacement value I could find. And what happened when I was doing that is sometimes I would find a really good asset that was beaten up and nobody loved it, and it was kind of ready to turn around. But most of the time when I did that, I was just buying crap. There are certain assets that hide under REITs sometimes that really shouldn't be REITs. And one example I'll use is hotels. I don't think hotels are a very good asset class for REITs because they're too dependent on the economy. A hotel that has 65% occupancy makes money. A hotel with 50 to 55% occupancy loses money. And that's not what I wanted in a REIT. But what would happen is when the occupancy would go down to that 50% range, the REIT would sell at a big discount to the replacement value of the assets. And I would get very, very interested. Where now I'm much more of a quality kind of investor. I don't want to lose money, essentially, and I'm willing to take a little bit of, maybe give up a little bit of upside in order to make sure that I don't lose money. So now I'm much more associated with the quality aspects of everything. I want what I want. I want a good balance sheet. I want to make sure that there isn't too much debt. I want a good management team that sort of does what they say they're going to do and has a history of building value inside the REIT. I want a payout ratio. Bob mentioned the payout ratios are typically sort of 70 to 90% of your income. I want a payout ratio on the lower end of that side because I want a REIT to be able to reinvest in the business, grow the business, and to grow the distribution. I think that, you don't see a lot of REITs that grow their distributions. And I think that that is a excellent way to sort of separate the good from the bad, is that looking at REITs that have that history of growing their distribution. Is that something you look at, Bob, when you're looking at a REIT, that history of distribution growth? Do you want to see that, or is it something that's less important to you?
Oh, absolutely. I think if a REIT can grow distribution over time, that's definitely a plus, right? Because you could see most of the REITs are, I think yields about 5% typically, right? And it's great to have an initial yield of 5%, but if that yield is not growing, inflation quickly eats into your return, right? So it's good when these REITs could increase their distribution over time. And when you talk about like quality, right? You said now you focus more on the quality. I think for investment, I think it's easy to get into the nitty gritty and look at the evaluation and all the financial parameters. But I found sometimes it's good to take a step back and look at the macro, look at the big picture, right? Like one example, Nelson, you mentioned about hotel REITs, right? I know years ago I was looking at, I think it's called American Hotel Income Properties, where they invest in hotels and things like that.
That's
and I was
exactly the one.
Yeah,
I was just going to say that's exactly the one I was thinking of.
Yeah. And I was like, oh, this is interesting because I travel for business and I stay in hotels quite a bit, right? I was like, this is interesting. And then when I looked at it more and more, I was like, yeah, like, does this make sense? Like, is it better to invest in that versus, a REIT with like, say, smart centers, which I mentioned earlier, their big anchor customer client or tenant is Walmart. And when you think about it, how many times have you seen Walmart closing, right? Like once they set up shop at a city, they usually last for a very, very long time and they don't move around, right? Whereas hotels, if the economy goes down or, COVID happened, people are not traveling, hotels, they shut down, right? Whereas Walmart typically don't, right? So that's where it's important to step back and look at the big pictures and really think about what makes sense, right? Because just because the numbers look good may not necessarily mean you'll get a guarantee good return, right?
Yeah, that's exactly it. And that's a really good point because it's tough for, me, my investment journey is I really started out as a hardcore value investor. It was how cheap can I get anything? And that was a tough transformation for me to figure out that quality matters and that macro matters. And it's tough because you want to buy assets as cheaply as possible. And I run into this all the time with people I talk to, people I meet, is that, you want to get a deal on things. Humans love getting deals on things. That's why flyers at supermarkets work, because we love getting deals. But the quality usually wins. And you have to be incredibly patient to find quality on sale and for a good price. And for a lot of investors, they just can't. So what do? They will sort of look for stuff that's on sale, but the quality isn't there. And that's a really tough challenge for the average REIT investor. And I would caution anyone doing it. I've been there. I feel your pain. And trust me, it gets a lot better buying REITs when you focus more on quality rather than that valuation. Mom, I think we should take the rest of this episode and just
to
Yeah,
talk
go
about
ahead.
more quality, right? So like, for example, some of these REITs are investing in business, right? Office buildings. And during COVID, as remember what it was like 4 or 5 years ago, a lot of companies, you don't go into offices, right? You're working from home. In fact, I was working from home for probably something like 4 years full time. So a lot of these office REITs really tanked, right? The numbers may look good, but like their tenants are not fully utilizing the space, right? So that's where, again, you have to kind of step back and look at the macro, look at the big picture, and see, hey, does this make sense or not? I think that's very important.
Yeah, I agree. Let's focus on a few different REITs for the rest of this episode here. Why don't we talk about smart centers first? I know that you kind of talked about it a little bit, but I'd like to just add with smart centers the genius of having Walmart as your main tenant and why it's such a powerful business model is that Walmart attracts all sorts of traffic. Everybody goes to Walmart. You know, it's like everybody says they don't go to Walmart, but they go to Walmart. I go to Walmart all the time. It's a fantastic combination of cheap and you can find everything there. It's great. I'm a former grocery guy, so I just walk around and check things out and look at new products. And that's probably a little weird, but Walmart is just this fantastic anchor tenant. And then what it does is it attracts all of this foot traffic into this parking lot that goes to other stores. You might have like a Dollarama there. You might have a couple fast food places there. It attracts all this traffic. And then that traffic is a huge benefit for the other tenants in the complex. I think it's a fantastic business model, and I'm a big fan of smart centers too. Bob, do you know the history of smart centers, how it sort of started, and the kind of that?
Can't remember
Can
exactly,
you
but
talk a little bit more about that?
I can't remember exactly. I know I looked into it, but right now I can't remember. But I know when we first started doing research on smart centers, the fact that Walmart is an anchor customer of theirs definitely entices to invest, right? Just like you said, like Walmart is such a big company, it brings a lot of foot traffic. If you have like a Walmart in a shopping mall, you'll get a lot of foot traffic, and that kind of drives the whole shopping mall. Like just more people there means more spending, etc. Right? And Walmart serves such a wide demographic of people, right? I mean, we go there occasionally. We have friends that go there that we run into all the time when we visit, right? So I think that's the key thing that really attracted me when we looked in smart centers. Do you know any history on smart centers, Nelson?
Yeah, and I want to mention the history because the Walmart angle is ingrained in Smart Center's DNA. So Mitch Goldhar was the founder of Smart Centers, and he's still involved. He's the executive chairman, I believe today is his title. And he went to Walmart in 1994, 1995 and said, you guys should expand in Canada and I'll build the real estate for you. And they put him off for a little bit and they put him off for a little bit. And then finally one day they made the acquisition and they decided to expand into Canada. And then he got the phone call. And that's how Smart Centers was born. There was also Callaway REIT, which was also a Walmart anchor tenant REIT, and then the two combined together. So Walmart is the basis of Smart Center's portfolio. They've expanded a little bit from Walmart since then. They've got some like mixed use towers with some residential properties on top and things like that now. But like Walmart and Smart Centers are almost one in Canada. They're not exclusively Walmart's largest landlord, or they're not exclusively Walmart's landlord, but they are Walmart's largest landlord. And I love that relationship. And I think that relationship's a huge plus going forward.
For sure. And again, like how many do you remember? Do you know any Walmart that closes down? Right. Like I mean, obviously there are
Exactly.
few, but once it's kind of like Costco, like once they establish a Costco or Walmart in a town, like they'll be there for a very long time, right? And knowing Walmart, I wouldn't imagine they would miss their rent payment, right? So it's a stable, very very stable tenant.
Exactly. And I'll add too, before we move on to another one, is that Walmart will often share a complex or a development with a grocery store. You will often see Walmart next to a Sobeys or whatever, because even the grocery stores realize that Walmart draws in so much traffic that they get the benefit of that by being beside a Walmart, close to a Walmart, and then people will go to the grocery store and get kind of some of the things that they can't get at Walmart. So even a grocery store will see the benefit of that. Let's pivot over to Granite REIT. Bob, I think you own this one as well. What was the thought process of buying Granite?
Yeah, like we were talking about it, right? Investing in retail warehouses, things like that, and that's really attractive to us, especially with online retailers like Wayfair, Amazon, etc. Like these online retailers need places to store their inventories, and that's where Granite REIT comes into place. And also, I can't remember exactly how much their history of dividend increases, but they have a tendency to increase their distribution over time, unlike many other REITs, right? So their distribution or their payout has been increasing over time. So that's quite attractive as well.
Yeah, I think it was 2012, I think was their IPO. And as far as I know, they've increased their dividend every single year since that IPO. So it'll be 12, 13 years in a row now.
I think so.
It's been a wonderful record.
Yeah, I think they raised dividends late, like December last year. I mean, the increase isn't really high typically because they're already pretty high yield, but they definitely have a consistency of raising every year as far as I can remember. Do you own Granite?
I do. I was going to mention two things that I really like about Granite, and one is it has a fantastic balance sheet. And I remember researching this when I first bought Granite, it's a few years ago now, and I remember researching that when the IPO came out, it had I think like an 18 or 20% debt to assets ratio. So that means for every dollar of assets that it owned, 80 cents were equity and 20 cents were debt, which I thought was just fantastic because that's the best REIT balance sheet in Canada. The debt's gone up a little bit now. I think it's about 35% of assets, but that's still the best REIT balance sheet in Canada. And what I like about a strong balance sheet so much is it gives you that security, and especially on the distribution side, where if they need to, they can borrow. And a bank is going to be very happy to lend these guys some money because the balance sheet is so good. It's like having a real estate portfolio with 35% leverage on it is very, very low. In fact, they should probably have a little bit more debt, but I was really comforted by this fantastic balance sheet. The other thing that I really like about Granite is they have a low payout ratio. I think it's about 70% of funds from operation, which is a REIT's equivalent of earnings.
Yep.
Which I love. Like, I want a REIT to be able to reinvest that income without having to go to the bank. Now, obviously, a REIT will borrow, but the more of shareholders' equity or like their earnings that they can reinvest, the better. I'm really a fan of that.
Yeah, and I like the fact they're not just in North America, right? So Granite, they operate in both Canada and the US, but they also have properties in Germany, Netherlands, and Austria, right? So it's not North American concentrated. So I like that quite a bit.
There's some auto parts exposure to Granite. So for the
Mhm.
people who aren't familiar, Granite was spun out of Magna, the big auto
Yep.
parts giant, and it was essentially all their real estate. And then over the years, Granite has expanded from being Magna's landlord to being all sorts of different companies' landlords. But I think it's about 15 to 20% portfolio exposure is still in Magna. And some of the European assets too are rented to Magna. Bob, does that
Yeah, that's my
exposure
understanding as
to auto
well.
parts,
I think it's
does that concern you
fine.
at all?
It's fine. Like I think over time it has the concentration Magna has decreases, right? So they now, I think if I recall correctly, Magna is definitely one of their top 10 tenants, but they also have tenants like Amazon, Samsung, Walmart, AC Hardware, Wayfair, and etc. So it's more diversified, and I think the top 10 tenants make up less than 50% of their annualized revenue. So it's a little bit more diversified now, right?
Yeah, I agree. It's not a huge concern to me, but the stock, I think, went down to the high 50s in April there with the tariff issues
Mm-hmm.
and things like that, which in hindsight was a wonderful buying opportunity. I think it's gone, I guess we record this, it's in the low 70s again, which is a nice 20% gain. And in what, 4 or 5 months, it was a nice time to buy back then. But of course, it's a nice time to buy everything back then.
Yeah, for sure.
I want to talk about Choice Properties. Are you super familiar with Choice Properties, Bob? I don't think you own it, do you?
We don't own it, but I think it's anchored by Loblaw, right? Like Superstore and any Loblaw company like properties. Is that correct? I think you own that. Do you?
Yeah, I own a. I'm not sure if it's my largest REIT position, but if not, it's up there. I own quite a bit of it. You're right. It is anchored by Loblaw. Something like 60% of rents come from Loblaw stores. And I know probably some of the people listening are immediately freaked out by that, but I'm not. I think Loblaw is such a fantastic tenant that I'd be happy if they increase that percentage over time. You have, Loblaw is obviously Canada's largest grocer. I think it's Canada's best grocer. They just do such a fantastic job. And then of course you have Shoppers Drug Mart on top of that, which has become sort of this urban go-to drugstore, but it's more than a drugstore. It's kind of almost like a grocery store for a lot of people in Toronto, Vancouver, these denser urban areas. So I really like Choice because of that Loblaw connection. But I mean, there's more to it than that. There's the balance sheet. Balance sheet's good. Distributions about 75% of FFO, which I think is on the low end. I like that. But a lot of it is sort of the same thesis as smart centers and
Mm-hmm.
Walmart, is that a superstore or a no frills even is a pretty good anchor tenant. They bring in people, and those people, while they're there, will go to a different shop, restaurant, whatever. The other thing I like about Choice Properties is, Bob, is there like a superstore? Are they in Vancouver? Like, do you have those big, 200,000 square foot superstore? It's almost like a Walmart, or is that just a prairies thing?
No, we have one here. I actually live about 10 minutes away from a big superstore, and yeah, it's not just groceries. You could get, basically everything. It's just like a Walmart store, right? And it's interesting. They're actually across from each other. So you could definitely see a lot of foot traffic in both that superstore and Walmart close to us.
Yeah, what I like about those developments from owning the real estate perspective is that you have these massive parking lots, and smart centers is the same way. You have these massive parking lots that are probably a little bit too big for what they have on them, and you have these redevelopment opportunities over time. And I'll talk about the superstore that's relatively close to my house in Edmonton. For the longest time, it was just this massive parking lot, and Choice has redeveloped things on there, and now there's There's a superstore, liquor store there, and there's a number of fast food places that are there as well. And the economics on these developments are quite attractive because the land was paid for. In this case, I mean, that superstore has probably been open for 30 years. So they paid for the land 30 years ago. And then there's these new developments that have popped up on it. So you've got that going for you as well with this, is that there's all this old land that essentially you're buying at a discount. I haven't done the math in terms of how many acres of land you're getting with something like Choice Properties, but I'd say that that way to buy land is a much, much cheaper way to buy land versus trying to do it yourself.
Yeah, you hit the spot right on. I'm just thinking about the superstore close to us, and just looking up, that's definitely managed by Choice Properties, and just thinking that has a superstore, has a Shoppers next door, and it's in recent years it's been opening up a lot of restaurant, retail shops, even healthcare like physio offices and other different types of stores. And really, the parking lot was pretty empty before, like years ago, but now it's always busy, right? So they definitely bought a huge chunk of land, put a superstore there, a Shoppers there, and then kind of slowly build up, right? And there's like a Dollarama there too, and a few other like big name stores really anchoring this space, which I think works really well.
Yeah, that's a great point, because you buy this land, and 30 years ago, that land was probably in the suburbs. And I'm thinking of the Edmonton location here, but it's probably the same in your neck of the woods too. It was in the suburbs, and then the city grew, and all of a sudden that land isn't in the suburbs anymore. It's surrounded by people. And when you expand something like that, or even if you have a tenant that moves out, it's not a big deal to fill that space, because you can go to prospective tenants and you can say, hey, look at all the people that are around here, and look at all the foot traffic this store brings in. You're going to want to rent this. And that's why Smart Centers and Choice Properties, they each have 98, 99% occupancy pretty much at any time, because they offer that appeal that it's very good for occupancy versus something like a retail stock or retail REIT that might own more standalone properties. They would have maybe like I'm thinking maybe something like RioCan. RioCan's got about a 90% occupancy. Maybe it's up to about 95, but that's a little bit lower than what you're seeing with those other guys. And that's obviously, it's better to have higher occupancy.
For sure. And the three that we talked about already, Smart Centers, Granite, and Choice, we talk about anchor customers. So when you look at and we talk about quality before and versus looking at the financial data and the balance sheet, obviously it's important. But if you were to start new now, looking into the REITs sector, would you do your research by starting and understanding who are the anchor customers for these different REITs first, and kind of looking at it from a 30,000 foot view to see whether that makes sense or not? Or would you do it the other way and look at the balance sheet first?
That's a great question. I think both are important, but I really like the thinking of looking at that anchor customer and that anchor tenant and seeing that stability there, because there's just so many advantages to having a really great retailer anchor your development, that you can do a lot of things wrong, but it still ends up okay, because you've got people still coming to Walmart and people still coming to blah, blah. So if you made me pick one or the other, I would probably pick that anchor customer, or just that, if we want to sort of expand it from there, because of course like a residential REIT won't have an anchor customer. It has hundreds or thousands of tenants. But if you sort of have that secret sauce, if you want to call it that, something that elevates you above your peers, that's important always. And you can't replicate that. I can't start a choice properties. No matter how much money you gave me, I could never be Loblaws landlord of choice. And that's a moat. And we like to see moats when we invest. So I think that if you made me pick between one or the other, I would pick that, maybe not like necessarily an anchor tenant because that doesn't apply for everybody, but I want to see something that can't be easily replicated.
Yeah, I think I fully agree with you, right? Looking at it from a big picture, I think over time become more and more of a big picture type of investor. Obviously, numbers are important as well, but especially REITs, I think this is more applied to retail REITs, right? Where if you have an anchor customer, like you said, with apartment REITs, it's kind of hard to see that. Or even office REITs, I'm sure you may have like a bank that rents out a lot of the office spaces in office REITs, but I think it's more important in retail REITs, right? Having that anchor tenant. Yeah, I think it kind of helps you eliminate some of your potential REITs and then kind of focus on one or two and start doing your research, right?
Yeah, I agree. And I think that there's something like 40 or 45 REITs in Canada. There's all sorts of different asset classes. There's multiple different ones in each asset class. And it's very easy to sort of over diversify and own a little bit of a whole bunch when probably your best bet is to own more a few. We're just about out of time here, so I'm going to end it with one last question. What do you think of REIT ETFs? Is that something that you would hold, or would you rather buy a handful of individual REITs and do it that way?
That's a very good question. I think for us, I would rather own a handful of REITs. Like what you said, Nelson, it's easier to make your own composition of REITs and, try to diversify that way. I think it's easy to own like all of them, but there's definitely some REITs that we wouldn't touch, right? Like I said, like the hotel REITs, right? I wouldn't, that if given a choice, I wouldn't include that in our portfolio. And, when we started investing in REITs, I don't know, over 10 years ago, we definitely own a lot more REITs than what we have today. Like today, we only hold 3 REITs. So we have trimmed down our REIT positions. And the reason is we just want to really focus on these top quality REITs, right? And I think with ETF is great, like you get fast diversification, but that could come and bite you as well, right? So I tend to like to just select the one that I know well and I believe will do well over time. What about you?
I agree. I would not buy a REIT ETF, and for the reasons that you mentioned, which were fantastic. I'll add a couple more. One is that those sector ETFs on the TSX generally come with relatively high fees. We're talking maybe 50 basis points, 60 basis points, 0.5% to 0.6%, which I think is way too high. Having to spend that every year on a REIT to own a collection of REITs, I don't think makes any sense, especially in a world where transaction costs are essentially nothing. The other thing is that a REIT ETF, most of them are market cap weighted or they're equal weighted. And either way, it's like, do I really want to own more of something simply because it's bigger? Or do I want to do my research and focus on quality? And equal weight's the same thing. Do I want to own a little bit of every REIT? Or do I want to own a lot of a few different ones? And for me, it's a very easy answer to that question is I'd rather own fewer and have bigger positions in each. Now, saying that, I do have a portfolio that probably has, I'm going to guess, 8 to 10 different REITs in it today. And that's too many. But at this point, I'm not selling because I don't really want to. REITs have not been in favor for the last couple of years, and I don't want to sell when they're low. So I've just been holding on and kind of waiting for them to, interest rates to go down and then people to be more attracted to REITs again. And then I can sell at a higher level and concentrate more on the largest ones. I've also concentrated more of my assets into sort of like 3 or 4 core positions in REITs, and then the other ones that I have are much smaller positions, kind of like legacy positions that, like I said, I'm just waiting to sell. So
Yeah, that makes a lot
Bob,
of
I think
sense.
that'll about do it for this episode. Any last thoughts you wanted to chime in with before we go?
Yeah, I think we could definitely go for longer to just talk about REITs. But if the listeners have any questions or any, reach out to us, our respective blogs, or even on Twitter or X, whatever you call it now, right? More than happy to chat or even send us an email. But yeah, it's interesting. REITs is definitely a good way to get into real estate and potentially get a little bit higher yield initially. But like Nelson said, there's so many REITs out there. There's also so many different REIT ETFs. You really need to do your research. And I hope by us talking about REIT for 45 minutes or so, it will make you understand a little bit better with REITs and get you a sense why invest in REITs.
Yeah, I agree. You have to be careful. This isn't just a buy, hold, forget sort of asset class. You want to go for the best ones, and then you can kind of take your hands off and say, I've got these tailwinds helping me, and I'm happy to just let them do their thing. Maybe in the future, we will dedicate another episode to REITs. We can go more into maybe smaller ones or whatever. We'll kind of figure that out at that point. Bob, always a pleasure. We will talk again next week.
Sounds good.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.